1. Oh, come on. Give me a better clap. Let's do this. 3, 2, 1. Ooh, there it is. Let's start. Hey, welcome everyone. This is Greg with G Money, everything mortgages and real estate. And today I'm joined by
Sarah Abrams,
the
one and only.
Got the wife in here to assist me to make sure that I'm staying in line, staying on point, and making sure that I'm speaking the information. There's a lot of information today, so it's a matter of making sure that I'm keeping it understandable and relatable.
Yeah.
Thank you.
Let's do it.
Okay, we're going to talk about property taxes. They're not fun to pay.
Yeah.
But they do provide for our communities, so let's be positive.
Yeah.
And it involves every single home, whether you are purchasing or refinancing, whether you already own a home, whether you're buying a home, whether you're selling a home. Property taxes are involved. So I want to get kind of the basis down, and then we're going to talk about some of the exceptions and then some of the transfers, and then we're just going to have our fun-filled day with property taxes.
Sounds great.
Let's fire away.
All right.
Okay. My discussion today is, here's my disclaimer. It's about the state of California and their specific property taxes. There's many states that collect property taxes, and they all handle them a little bit different. So for today, most of the business that we do and our client base is in California. So that's what we're rolling with.
All right.
Get it, got it, good.
Good.
Okay.
Good.
We have two main entities that deal with property taxes. These entities are specific to the counties throughout the state of California. So when we talk property taxes, we have a left hand and a right hand. The left hand is the Ventura County Tax Assessor. The right hand is Ventura County Tax Collector, okay? If you're anywhere in the state of California, whatever your appropriate county is, those are the people that you want to reach out to, okay? Now, the assessor, their specific role every year is to take and to provide a value for all real property. That would be residential, commercial, and they call them secured property taxes. So the property taxes are secured by not only the land, but the improvements, and that's the secured property taxes. And unsecured, or an example of something like that would be like a boat or a vessel where it doesn't necessarily have a parcel. It will have a parcel number, but it's unsecured, and you just pay based upon the value of that. Very similar, but it's secured versus unsecured, okay? So with that, you purchase a home, and the county determines a value at which that home is worth. That is not always the same as the purchase price, okay? I'm going to say by default it is, but there's going to be situations where you can inherit a home and there's a property tax base that once you acquire that property, you're kind of grandfathered in. And so we still find today homes where a family or a little old lady has owned the home for 50 years and she's paying $500 a year in property taxes for $1 million or $2 million home. In today's value of $1 million or $2 million, the property taxes would be, tens of thousands of dollars per year.
Oh, okay.
So anyways, we have the assessor that determines the value, and then they hand that over to the tax collector, and the tax collector takes the value and applies the tax rates for that home or that property. Now, every neighborhood has different rates, and the way to how expensive are these rates, right? So when we do not have a specific property identified and we're trying to qualify someone for a home loan, the minimum tax base for this entire state is 1%. Plus, there's different bonds and measures by the neighborhood. And so as a default, without identifying a specific address, we would qualify at 1.25% of the purchase price. Okay. that extra 0.25% typically should be enough to cover various, school bonds, measures, fire department, whatever those may be. Now, the older and more established the neighborhood, the general rule of thumb is that those property tax rates will be much lower than something that is brand new. And we're going to get into kind of the extreme cases of that with some of the Mello-Roos, et cetera, et cetera. Now, again, how much are the taxes? It's a 1% base plus voter-approved local bonds and measures. The approved bonds and measures are as a percentage and sometimes as a flat dollar amount or direct charge. So it could be 0.25% or it could be $15, depending upon what that assessment is for.
Sure.
And so that's how they work. You multiply that out by the value, and you determine a dollar amount that you are taxed in the form of property taxes. The property taxes are due twice a year, and so they have semi-annual installments with kind of funky dates the way that they're paid. So you take a January through December, you break it up into January through June 30th. That's the first half of the year, but it's not billed then.
Yeah.
And then we have July through December, and then the actual bill dates is the first installment is due November and it's delinquent by December. The second installment it's due by February, delinquent by April. And so that's kind of the terminology is you get one bill. That bill is sent to you in the mail September, October, no later than October. And again, it's due the first installment November and the second installment in February. Now, regardless if you have a mortgage company that has impounds with taxes and insurance, you will receive a copy of the bill. And I always get this question like, why am I getting a bill? Well, guess what? It's your bill. You should be informed. You should be reading that over to see how much they're charging you.
Yeah.
Not only that, you should make sure, are you calling your mortgage company to assure that they've received the bill and that they're set to pay that on your behalf?
It's like setting up auto pay for something. You still get a bill. You need to know was there errors? Is there mistakes? That kind of stuff. Did something happen with your account and it's not being charged? Like, you need to know what's going on.
Absolutely. So the big thing here is taxes don't mess around. If it's 1 day late, your penalty is 10%. So for example, our property taxes on our home, they're a little over $6,000 per installment. So we would have a $600 late fee, even if it's 1 day.
You said delinquent, though, so there's that grace period, right?
Yes.
Okay, so there's a grace period, but then so beyond that date of the grace period is when that starts to accrue.
Correct. So let me get specific okay, it's due November 1st. It's delinquent after December 10th. That's their terminology. It's due here. Here's your grace period up till December 10th. December 11th, we don't mess around. Here's 10% late fee. The second installment is due February 1st, and it's delinquent after April 10th, right around the corner from the IRS tax date.
It's interesting that they have its longer grace period in the spring.
Yeah.
Right?
It is what it is. Yeah. I don't think by much, to be honest. Due February 1st.
But it's all of February, March, into April. In November, you just have November, part of December.
I don't know. It is what it is. But
They're feeling gracious.
They're feeling very gracious on that second installment. All right. So taxes, what happens is there is Proposition 13 that has been in play for many years, and it caps, and this is again going back to the little old lady example, that they've owned the home for 50 years and they have very, very low taxes, is it caps how much they can add to the assessed value per year. And that is a 2% max per year. So even if values, and in California, and specifically Ventura County, for the last 64 years, the average appreciation is about 6%. Instead of them raising the taxes 6%, the maximum they can do is 2%. Now, do they have to raise every year? No, they do not. There's been years that they've stayed the same. There's even been years that they've declined. So just kind of giving you an idea, those are the mins and maxes, I guess we'll say. But it doesn't sound like much now, but again, you go back to you own the home for 20, 30, 40, 50 years, these 2% caps really help add on that if you buy a home now for $800,000, it might seem crazy in the future that your home's worth $2 million. At some point it will, but you're only going to be taxed on $900,000 or $950,000, right? So it's going to give you some break at some point into the future. Okay. What other tax breaks are there potentially available? Number one is the homeowner's exemption. I highly recommend if it's your primary residence, you should be taking advantage of this. How do you know if you're taking advantage of it? You can look at your tax bill and it'll tell you if there's a homeowner's exemption. If it is your primary residence and you can only claim one at a time, I know it sounds self-explanatory, but that is the case. If you fill out a new form for a different property, it's going to remove the primary residence of the old property.
Transfer it to the new one, yeah.
Exactly. So they're going to catch on. But what it does is it reduces $7,000 in assessed value. So if your home is worth, per the county, assessed at $900,000, they would assess it at $893,000.
Okay.
That doesn't mean that you save $7,000 in taxes. It's the tax value. So it equates to roughly a little less than $100 a year. Okay. But that does add up, and you do want to take care of that, take advantage of that.
Sure.
Okay. Other opportunities for disabled veterans. So any of the veterans out there that are disabled per the VA, you can apply with the county, and there's some tax breaks. There are family transfers. There's also senior transfers. Those relate to Prop 19. And Proposition 19, if we get time, we can go kind of in depth into those. Who pays the property taxes? Ultimately, it's the borrower. You are responsible for that. 4 different loan programs. If you have a government loan, it is required. So this would be USDA, FHA, VA. If you have any of those, it's required that you make one monthly payment that is all inclusive to include the mortgage as well as insurance and the property taxes. So that's how that works. For conventional loans, commercial loans, other types of loans, it's optional for the impound account. For the mortgages that you and I carry, we pay our property taxes on our own. So instead of the money sitting with the bank, we hold on to that, and I make those payments when they're due and payable. So that's how that works. Okay, now, one of the big crazy things here is the first year of home ownership. And this is really where people get that first taste of property taxes. And it's not always the smoothest. And this is where every loan that I close, at the loan signing, we go over property taxes, not just how they're calculated, but how they're paid. And to reiterate, when they receive anything property tax related, they are to call me because I need to basically interject myself. And here's what happens, Sarah. It's a hot mess. It's the system that it is, and unfortunately, it is what it is, right? So we just have to accommodate as best as we can. Okay, you are Mr. Homebuyer, and you are purchasing a home, and you purchase a home, let's just say for $800,000, okay? When I do your loan, I calculate $800,000 purchase price as the value. I look up the specific tax rate for that home. That would include whatever the percentage is plus the direct charges. And I come up with a tax rate of 1.2. And so how does that work out? Is 1.2 times 800,000 divided by 12, and that would equal the monthly portion of that. Well, again, what happens is they are paid semi-annually. And so you are just buying this home for $800,000. The seller, they bought the home for $400,000. Okay. Their property taxes have been based upon their $400,000 purchase price for many, many years. Mm-hmm. You come along and buy it for $800,000. So you're doubling the value of the home. Now the county doesn't just flip a switch the day that you buy the home and say, okay, it's doubled, we need to double everything. What they do is they don't have time, a lot of cases, to send your file, that home, to the assessor and then redetermine the value and then update the bill prior to their standard cycle of sending the bills out. So as a default protocol, they will send you the first bill, the first installment of that property tax bill based upon the seller's old rate.
Okay.
Okay. So we're anticipating an $8,000 bill, but now we only get a $4,000 bill because that's the seller's old rate. Then what happens is the second installment comes and the county still has not caught up. So we get another bill for $4,000 instead of $8,000. And so now we're paying half as much. Well, the county doesn't just write that off.
Right.
Once they finally catch up to the whole assessed value, they're going to not only assess it correctly, but they're going to hand that off to the tax collector. They're going to send you what is called a supplemental tax bill. Here is the billed difference for what we should have charged you versus what we actually charged you. We should have charged you $8,000, but we only charged you $4,000. Here's a $4,000 supplemental bill.
And that's just whenever they catch up to it.
That is correct. Yes. Now, we've got a couple different things that happen, and if you do nothing, the cycle gets worse and worse and worse. You must act on it. And so let me kind of walk you through this. Mr. Homebuyer buy it. They know that their payment is all inclusive with taxes and insurance. They're paying their mortgage each month. They get their bill. They see it. They throw it to the side. Oh, it's been paid for. Their mortgage company, as a courtesy and as a requirement, that impound account that I talked about is required to analyze their money in that account once a year. It's like a savings account. And so when they analyze what was projected to be paid versus what was actually paid, they realize we have $4,000 extra that we never paid out. Hey, these property taxes are less expensive.
Ooh.
So what do? They send Johnny Homebuyer a refund for $4,000. Johnny Homebuyer doesn't call their favorite lender.
He goes on vacation.
They go to
buys
Disneyland.
something.
Yes, they're doing all the wrong
I
things.
see where the story's going.
Yes.
Yeah.
Okay. Then the supplemental tax bill comes. The supplemental tax bill only gets sent to the home buyer. It does not, I've said that twice,
Yes.
gets sent to the mortgage lender. So the mortgage lender, one, never knows it exists. Two, does not receive a copy of it for it to be paid. So you have to interfere. You have to actually take this statement, call your mortgage company, get it sent to the mortgage company for them to pay it. If you act immediate and you were one of my clients, you're going to pick up the phone because you've already been instructed what to do. You were made aware of this. We've talked about this. It's no big deal. Nothing crazy will happen. It just takes a few phone calls, maybe an email, a few text messages. We'll get it all handled. That nothing, no money, no $4,000 out of pocket needs to get fronted or anything like that. We can pass that bill along to the mortgage company and get them to pay it. This process, it is clunky, it's chunky, it's not great. It's just not great. I can't say that enough. Did we ever record?
I asked you, is green good? And you said yes. It was blue before the first time I asked you.
Yeah, we did not. It was blue because, well, we have the audio up
What does
here.
it look like?
It's not recording, but we have the video.
What is it supposed to look like?
It's going to be red. It was blue because it didn't have the microchip. But you have video up there, right? Yes.
Mm-hmm.
So as long as we have video. Yeah. We're batting 1,000 today. I know. Okay. So moving right along here, you call me and I get that supplemental tax bill paid. And it's no big bumps in the road.
So when I get these things in the mail, is it going to say supplemental tax? Is it going to be pink?
Yes.
Is it going to be
Yes.
calling my attention?
It's pink or blue. They decorate these in funky colors to stand out in your mail. They are legitimate. Instead of picking and choosing, this is a regular bill, this is a supplemental bill, you call me on any tax bill that you receive and I can walk you through it. And you know what? You're not one of my clients. I will still gladly, free of charge, help you out, help you to get these supplemental tax bills paid. It's a confusing process. I don't love nobody loves the process, right?
Yeah.
But we have to work through it. And so the path of least resistance is when you get tax bills to pick up the phone, to act on them, so that way it's smooth as possible. And I'm going to tell you what happens worst case.
That's what I was just going to ask. Like, so what happens if they toss it away? They don't pay
Okay.
attention to it. What's happening?
Okay. They toss it. They get a refund, which they go and spend. So now, once the county catches up, year number 2, they're going to send out a normal tax bill, an $8,000 tax bill. And the mortgage company, thinking that the bills were only $4,000 per year, have not only sent you a refund of $4,000, but they've also reduced your monthly mortgage payment. The amount that they were collecting for impounds, instead of $700 a month, they've now cut that down to $400 a month. You've saved $300 on your mortgage. Guess what, people? There's no artificial savings like that. If something changes more than $10, $20 plus or minus on your monthly mortgage, something is wrong. Okay. So what happens, this worst case, you get out of cycle here. They've reduced your payment. They've sent you a refund, and you still have all these supplemental tax bills due. What will happen is the mortgage company will step in. They will pay these supplemental tax bills. And the reason why is tax bills are very serious, that you could default on your home. Somebody could take your home away. Like you could, the county can take your home away if you don't pay your taxes. And so the mortgage company does not want that to even slightly occur.
Right.
So they will pay all of your delinquent taxes. But not only are they going to raise your payment back up the $300 where it started, that's to cover the deficit, but now you're severely short for what they also paid out in addition to
Fronted
that.
the money. Yeah.
So now your payment, instead of going back up $300 where it started, it's going to go up $600. $300 for the initial refund that they sent you, and then $300 moving forward for the additional taxes. So if you do nothing, you could wind up that your payment actually comes out significantly worse than where it started. Plus, you have to deal with all the late fees. Who pays that? That's not your mortgage company. That is you. That's the borrower. So I can't emphasize this enough. Supplemental property taxes, the first year of home ownership, can be tricky. Please go through, listen to that whole procedure and process again. Make sure you're calling me, so that way, as you receive these bills, it's a smooth and easy transition. The transition should be your payment never changes. You never have to pay anything above and beyond your normal payment out of pocket. And we can make all of that happen as long as you're contacting me when you get the bills. Not 2 days before they're due, but when you get the bills.
So then, ideally, theoretically, once you're past that first year and your property has been reassessed after the purchase and acquisition of your home, you shouldn't be receiving supplemental tax bills.
Correct.
Once all that's been kind of shaken out and taken care of. So once all that's been done, like moving forward, year 2, 3, 4, 15, it's going to all, I mean, there could be adjustments based on insurances and all that kind of stuff, but all of that should be kind of shaked out after that first year.
Correct. The only other example that comes to mind is where could you potentially have a big change in taxable value is remodeling your home, right? When you pull permits, when you submit the permit, it asks for dollar amount improvements. Are you putting on $50,000 of solar? Guess what? That could impact the value of your home. And then they're going to tax according to the value of that home. Not only solar, you did a gut job remodel, you did $500,000 of improvements. They're going to tax you on that. And so again, how they tax you is the old fashioned way of when they catch on, they'll send you a bill for the difference called a supplemental tax bill. So everyday taxes and just going on, more than likely, no, you're not going to get anything additional. But if you do improvements, do expect the improved values to be taxed.
Okay.
Now, some of the questions that I get, and I'm just going to kind of go through these real quick here, is if I refinance my home, will my property taxes go up? And that is completely false. People are concerned on getting an appraisal. And again, you bought the home for $800,000. The appraisal comes back, at $1 million. We do not turn that appraisal into the county, the assessor. It's not reported anywhere. The appraisal is, and there's different ways to appraise items, right? So the appraisal that we use in lending is the sales comparison versus like another example would be the construction method where the cost of materials. So cost of materials could be $1 million to build your home, but if comparable homes in the area are only selling for $500,000, that's what we're looking for is what are the market conditions, the sales comparables. So we do not, again, turn that into the county. Don't be concerned with that. Nothing financing related goes to the county where it could trigger that. Okay. Death of a real property owner. And this is where you do need to report it. The big thing here, and I want to talk about this, is getting your vesting correct. Vesting is how you hold ownership to a home. And so I can't reinforce this enough as well. And I can give you, examples of adding somebody onto title, whether it's at the time of their death or just because you're changing title. These are things that can trigger reassessment of property taxes. And so one, you want to consult either an attorney or financial advisor, somebody that deals with property, to talk to about the ramifications of being added onto title. It's a simple and easy process and it doesn't cost very much, but it could have very long-term ramifications based upon triggering, property taxes, right? Number two is how you hold ownership. And this is what we call vesting. I know we had Krista Hermance on here. They do have an option, sounded like a package where you can consult with them on vesting. And I highly recommend that because, again, go back to that episode, if somebody passes away and it's not properly vested or there's not the proper vessels in place, the property could go to probate, and that's going to cost minimum, it sounded like $50,000. It's not just the money, it's the time. It's a hot mess. Mm-hmm. And so vesting is, again, let me give some examples here, how you hold ownership. And so it's always the legal name. My legal name is Gregory Joseph Abrams. Do I want to take Gregory Abrams, Gregory J. Abrams, Gregory Joseph Abrams? My recommendation is as detailed and differentiating that you can make your name, especially if you have a common name. If your name is Michael Smith, that is a very common name. How many Michael Smiths out there? I mean,
Sure.
Yeah. So Michael J. Smith or Michael Z. Smith, you get some of those middle initials, but then somebody could have the same middle initial. So
Yeah.
again, the more common your name, I'd say the more detailed you should be in your name description. So Gregory J. Abrams, and then you would describe yourself. So it'd be, I could do it as a married man as his sole and separate property. So in California, that is, you can purchase a home by yourself, even if you are legally married, which I am. In order to do that, that would be my vesting. But then I would also be required to have my wife, Sarah, do an interspousal deed where she's acknowledging that I'm acquiring a property during our marriage. And she would sign off or relinquish her ownership in that property. Now,
She being me.
yes, you. Can you sign this, please, in front of a notary, please? Yes.
Talking about this person in third party. I'm sitting right here.
Well, I'm just giving an example
All right,
here.
all right.
All right, cool. Okay, now, if both of us were to marry, this is where it gets more complex. Now, we could be tenants in common, where I could give you 10% of the ownership and I could take 90. But then if you pass, that doesn't tell us where your 10% goes. So you have to have a will, a trust, something that after you pass instructs the heirs of what to do with your ownership percentage.
Right.
In contrast, joint tenancy it's equal ownership for the number of persons on title. So if it's you and I, we don't have to say 50-50. If we're joint tenants, we jointly own that equally. That's kind of what it's meant. If one of us were to pass, it automatically transfers the dead person's
Value of the
ownership
percentage of, yeah.
to the other person. So if I'm going to pass away, it basically goes from 50-50 to 100% to Sarah.
Okay.
So it transfers that, and it's a little bit, I'm going to say, smarter or more intuitive with how it happens after the fact. Now, the problem, and this can be, is joint tenancy does have some ramifications with triggering values with the county. And so you need to know and understand that. Ask as many questions as you can, not just to the lender, to the title officer, to a lawyer, but also the county. Know 3 steps ahead of what you're trying to do to make sure that it doesn't trigger anything.
Sure.
And then there's other things like having it in a trust. And you and I have our properties in a trust. So it kind of creates a shell entity of us on behalf of us. And we're the trustees of the trust. So we manage the trust, kind of creates a false person. So that's probably the most ideal way, especially as you out there listening are acquiring assets, multiple properties, you have children, you have heirs. That's the best way to protect everybody.
Very cool.
Yeah. So what else do we want to learn about in property taxes?
I don't know. I don't know what there is to learn.
Okay. Well, let's talk. I'm just going to briefly hit on this and then we'll just kind of leave it as is. We can get crazy sideways on property taxes, but one of the newest is, as of 2020, voters approved Proposition 19. Mm-hmm. And this is a good thing. Historically, it had to deal with only reciprocating counties, and not everybody was. And it's kind of like, I guess we'll call it, my game plan is I want to live and work in Ventura for all my working life. But when I retire, what if I want to move to a different home? Mm-hmm. And so I'm grandfathered into this property tax base here in Ventura with a specific home. How do we make that if I want to retire, I could transfer that to another home? And that's essentially what Prop 19 is you have to be a senior. It was approved November 2020. The Home Protection for Seniors, Severely Disabled Families, and Victims of Wildfire or Natural Disasters Act. Wow, that's a long one. It has 2 major components. One is allowing the homeowner who is 55 or over, disabled, or victims of a wildfire or natural disaster to transfer their lowest assessed value of their primary residence up to 3 times anywhere in the state. The second part of the proposition imposes new limits on property tax benefits for family transfers. The parent may transfer the lower property tax base to their child or children if the property is the principal residence of the parents and the child makes it their principal residence within a year. So that was also key as well. They did have some exemptions for that previously, but now they just kind of buttoned up the values, and it's not infinite value. You can't transfer a $2 million home. It's up to $1 million. Now you can transfer a $2 million home.
You just don't get
You don't get $2 million exempt. It's up to the first million that is exempt. And then the second part, or the first part rather, is for seniors where they can transfer their property tax base. And I've dealt with this multiple times with clients that I've had purchasing homes. Now, what I will say, the proposition is there. The law is there. You can transfer it. However, at the time of acquisition, you have nothing with the county that says that your tax rate's going to be $500 a year. So we have to qualify you at regular, normal property tax rates. You have to close escrow on that home, and then you can immediately apply to the county assessor for them to reassess the property. Then they would then pass that on to the tax collector. Now we have evidence of how much your taxes are reassessed. Then you could update your mortgage if you have it impounded to show the new tax rate.
So there's nothing for someone to do preemptively before they close a loan. They have to come in and qualify as if they're me, not a senior, not receiving a transfer or anything like that. I have to qualify as is. And then in the future, once everything's closed and I do the application process, you set the assessor, that if they approve it, then I'm going to get a reduced assessment and a reduced bill.
That is all correct. Now, I would say don't do nothing. I would still reach out. I would either call or go to the county assessor directly and go over the rules and nuances of how the rules work and compare that with what your game plan and what you're wanting to do. It makes a big difference financially for you. And so to make sure that you're doing everything correctly ahead of time is very vital.
Sure.
And that's not my role, right? This is yours because it's your property taxes that you're grandfathered into.
You want to make sure that, one, you're going to be able to do it.
Absolutely.
And you're doing the right process.
Yeah. The assessor is at the government building over on Victoria. I've been in there many, many times. I'd say they're very nice. They're willing to chat with you. You can run any scenario by them. They want to help you. So go chat with them if you have questions of what you're wanting to do just to make sure that it all fits.
Cool.
Boom. Do you understand all this property tax stuff?
I'm a guru now.
You passed the test.
I'm not. Do not call me and ask me about your property taxes.
You can call me though. And again, this is Greg, and I would be happy to help you out, get your property taxes all taken. For today, I think this is as in-depth as we need to go. There's always those one-off questions that you have, those little nuances, the what about this, what about that. You know what? You give me a call and we will what about that together.
Sounds good.
For today, my friends, thank you so much for tuning in on property taxes. It is complex. It can be smooth. It can be easy. And we're going to get you all taken care of here at American Pacific Mortgage. I want to let you know, coming up, I finally landed a financial planner that is willing to sit down and talk. We're going to talk all to them about programs, options, details, rates. No, we're not. Compliance is all over that industry. FinCEN, you got them on lockdown, baby. Everybody is scared to chat with us on the open hot mic. Well, you know what? We do really have a guest that is a financial planner. We're going to get that scheduled and get them in here so that way we can get those questions asked and answered and get all that valuable information to all of our listeners. So that's coming up next. Hope you're having a beautiful week. It is fall out. It is feeling good. We're almost to Halloween. Man, make it a great one. thank you for tuning in to Greg and G Money, everything real estate and your mortgage needs. I butchered that. Sarah, why don't you take me out here? Take me out.
Thanks for tuning in to G Money, real talk on everything mortgages and real estate.
Boom. That's how you do that. All right, guys. Take care. Have a good one. We are way too rusty. So...